Stop everything for a moment and focus, because what is unfolding in the silver market right now is not routine volatility, not another speculative spike, and not just another headline designed to grab attention. Today we are witnessing a structural shift that could redefine how silver is priced globally for years to come. This is not about a short-term rally that fades in weeks. This is about multiple powerful forces aligning at the same time across continents, across institutions, and across financial systems. And most investors still do not see the full picture. Major banks are issuing aggressive projections. Eastern markets are breaking price barriers ahead of the West. Policy decisions in one of the largest precious metals consuming nations on Earth are unlocking entirely new layers of demand. Futures market positioning is showing signs of exhaustion. Legal exposure is revealing how the largest trading firms actually operate behind the scenes. These are not isolated events, they are connected. And when you connect them properly, what you see is not noise. You see the early stages of a potential paradigm shift. We just received projections from Croup, one of the largest banks in the world, forecasting silver at $150 per ounce. That number alone should demand attention. This is not coming from a small newsletter or a social media personality looking for engagement. This is a global financial institution with vast capital, extensive research capabilities, and access to institutional flow data that retail investors will never see. When a bank of that scale places a target like $150 on silver, it signals something deeper than optimism. It signals positioning. It signals expectation. It signals that high net worth clients are being prepared for the possibility of significantly higher prices. Institutions do not casually publish targets that far above current pricing unless there is a framework behind it. And when institutional frameworks begin to change, markets eventually respond. Now layer on top of that what is happening in Shanghai. Silver prices there have already pushed through $100 per ounce. Let that settle in. In one of the largest physical precious metals markets in the world, silver has crossed a level that many Western investors are still waiting to see. Meanwhile, the Western paper benchmark, the ComX price that dominates financial media coverage, is trading near $93.80. That gap matters. It matters because Shanghai reflects a market where physical delivery and real metal transactions carry weight. When a physical market trades above the paper benchmark, it suggests that demand for tangible metal exceeds what paper pricing mechanisms are currently signaling. This divergence is not a trivial detail. It is a crack in the pricing system that has governed precious metals for decades. For years, the dominant price discovery mechanisms for gold and silver have centered around Western futures exchanges and the London bullion market. These platforms have controlled liquidity, settlement frameworks, and global benchmarks. But when Eastern markets begin trading at persistent premiums above Western paper prices, the foundation of that dominance begins to shift. A market where physical buyers are willing to pay significantly more than the quoted futures price is a market experiencing tension. That tension builds over time, and when it builds long enough, it resolves through repricing. Now consider India's recent move to allow silver to be monetized as loan collateral. This is a development that many Western analysts are underestimating. India is one of the largest consumers of precious metals in the world. Silver and gold are deeply embedded in cultural, financial, and generational practices. Households across India collectively hold enormous quantities of silver. Historically, much of that metal has functioned as dormant wealth, valuable but inactive. Now, by allowing silver to serve as collateral for loans, India has effectively transformed stored metal into productive capital without requiring households to sell their holdings. This policy change accomplishes two powerful things simultaneously. First, it increases the utility of holding silver. Ownership now provides liquidity access without liquidation. That alone enhances silver's attractiveness as an asset. Second, collateralized silver becomes temporarily locked out of the open market. When metal is pledged against loans, it is not available for immediate resale. That tightens supply. And basic supply-demand mechanics tell us what happens when supply tightens while utility increases. Price pressure builds. But the implications extend even further. When precious metals integrate more deeply into formal financial systems, they gain legitimacy. Institutional participation becomes easier to justify. Banks build frameworks around custody, valuation, and lending. Once infrastructure forms around an asset class, capital begins to flow more efficiently into it. India's move is not a minor policy adjustment. It represents a structural shift in how one of the world's largest economies interacts with silver. Now introduce another element that is receiving far less attention than it deserves. Regulatory adjustments could allow approximately $385 billion in stock funds to allocate toward gold and silver. This is not about mandates. It is about removing restrictions. When barriers fall, optionality expands, and $385 billion is not an abstract figure. It represents capital capable of materially influencing price if even a fraction reallocates. 5% of that pool equals over $19 billion. 10% approaches $39 billion. In a silver market that has already experienced structural deficits, incremental inflows of that scale would be significant. Notice how these developments are converging. Croup projecting $150, Shanghai pricing above $100, India unlocking collateral utility, potential fund flows measuring in the hundreds of billions. These are independent catalysts pointing in the same direction. When multiple structural forces align, markets can transition from consolidation to acceleration quickly. At the same time, something critical is happening in the futures market. ComX silver open interest has dropped to a 13-year low. Open interest measures the total number of outstanding futures contracts. High open interest often indicates heavy speculative participation and leverage. Low open interest suggests contraction, liquidation, and reduced speculative exposure. When open interest reaches multi-year lows, it often reflects that leveraged participants have been flushed out. Margin hikes, volatility, and sharp price swings tend to eliminate weak hands. What remains is a thinner market with less speculative overhang. Why does that matter? Because when new demand enters a thinner market, price moves can be more dramatic. With fewer leveraged positions suppressing rallies and less synthetic supply available through excessive futures activity, upside pressure encounters less resistance. Historically, bull market advances often follow periods of washed-out open interest. A reset clears the foundation for renewed participation. There is another dimension that investors should understand, and that is the ongoing litigation involving Jane Street. As one of the largest global market makers, Jane Street plays a significant role in providing liquidity across asset classes, including precious metals. Legal exposure surrounding large trading firms reveals the complexity and asymmetry embedded within modern financial markets. These firms operate with advanced algorithms, access to order flow data, and execution capabilities far beyond what individual traders possess. Recognizing this reality is important. It underscores the difference between trading leveraged paper contracts and holding physical metal for long-term positioning. When participation is leveraged within institutional frameworks, short-term price dynamics can become distorted, but long-term fundamentals ultimately revolve around supply, demand, and ownership transfer. If the physical market tightens while paper positioning contracts, the balance shifts. Now bring gold into the equation. Gold recently broke above $5,280 per ounce. Over the past week, gold appreciated 3.5%, while silver advanced nearly 11%. That level of silver outperformance is noteworthy. The gold-to-silver ratio, which measures how many ounces of silver equal 1 ounce of gold, has remained elevated for years. When silver begins outperforming gold, it often signals entry into a more aggressive phase of the precious metals cycle. Historically, silver tends to lag early and then accelerate rapidly later. Taken individually, each of these developments could be dismissed as isolated. Together, they form a pattern. Institutional projections are rising. Eastern pricing is exceeding Western benchmarks. Policy shifts are expanding collateral utility. Potential capital rotations are emerging. Speculative futures exposure is contracting. Legal scrutiny is exposing structural asymmetries. And gold is confirming broader precious metals strength while silver outperforms. This is what a transition phase looks like. It does not announce itself with certainty. It builds gradually through alignment. Today, that alignment is visible. The question is not whether volatility will continue, it will. The question is whether these converging structural forces represent the early stages of a sustained repricing cycle, and based on the evidence in front of us, that possibility cannot be ignored. Now let's go deeper, because understanding what is happening requires more than just repeating headlines. It requires understanding how pricing power works, how capital flows operate, and how shifts in market structure unfold over time. For decades, the Western pricing mechanism centered around the futures exchanges in New York and the bullion system in London has effectively dictated global precious metals prices. Liquidity concentrated there. Settlement conventions were established there. Benchmark contracts were standardized there. And because global finance relied heavily on those systems, the rest of the world largely accepted the price those markets produced. But dominance in markets is not permanent. It depends on trust, liquidity, and alignment with physical reality. When the paper benchmark begins to diverge meaningfully from physical markets, tension builds. Shanghai trading above Western paper pricing is not just a premium, it is a signal. It signals that buyers in that market are valuing physical metal differently than paper traders in New York. When that divergence persists rather than disappears quickly through arbitrage, it suggests structural friction. Arbitrage, in theory, should close price gaps. Traders buy in the cheaper market and sell in the more expensive one. But arbitrage requires available supply and smooth transfer. If metal is not easily available for export, if inventories are declining, or if long-term holders are reluctant to release physical supply, arbitrage becomes constrained. When constraints appear, the price gap can persist longer than expected. That persistence becomes evidence of strain within the pricing framework. At the same time, India's collateralization policy begins to reshape demand dynamics. Historically, when Indian households needed liquidity, selling physical metal was one of the only options. That selling introduced supply into the market during periods of financial stress. Now, with the ability to pledge silver as collateral, selling pressure may diminish. Instead of liquidating, households can borrow. That changes the behavioral pattern of supply release. Silver that would previously re-enter circulation during economic strain may now remain locked within collateral frameworks. This is not speculation. It is a shift in how metal interacts with the broader financial system. When assets gain collateral status, they become more than commodities. They become financial instruments integrated into credit systems. Integration increases relevance. Increased relevance increases institutional comfort. Institutional comfort invites capital allocation. Speaking of allocation, the potential $385 billion in stock fund capital capable of rotating toward gold and silver is not something to overlook. Capital flows operate incrementally at first. Funds adjust exposure gradually. Committees evaluate performance, volatility, and correlation. Small allocations begin as test positions, but once allocation begins and performance confirms thesis, adjustments can accelerate. In a market like silver, which is relatively small compared to global equity markets, modest reallocations can have outsized price impact. Now combine thinner futures positioning with potential institutional inflows. ComX open interest at a 13-year low suggests speculative leverage has been reduced dramatically. Many participants who traded silver aggressively during prior spikes have exited. Margin increases and volatility forced liquidations. When open interest contracts significantly, the market becomes less crowded. A less crowded market can respond more rapidly to incremental demand because fewer leveraged short positions exist to absorb buying pressure. Historically, major bull legs often follow periods of contraction. Markets require resets. Excess must clear before sustainable advances begin. With open interest compressed and physical premiums appearing in Eastern markets, the structure appears cleaner than it has in years. Now consider the broader gold market confirmation. Gold breaking above $5,280 per ounce reinforces the macro environment supporting precious metals. Over the past week, gold gained 3.5%, while silver advanced nearly 11%. That relative strength matters. When silver begins outperforming gold after long periods of lagging, it frequently marks transition into the more aggressive stage of a metal cycle. The gold-to-silver ratio has been elevated for years, indicating silver undervaluation relative to gold. Ratio compression typically coincides with strong silver rallies. But there is more. Industrial demand for silver remains robust. Silver plays a critical role in electronics, renewable energy infrastructure, solar panels, and emerging technologies. Unlike gold, which functions primarily as monetary metal and store of value, silver straddles monetary and industrial demand. That dual role creates sensitivity to both macro financial flows and industrial consumption trends. When monetary demand rises simultaneously with sustained industrial use, supply strain intensifies. Supply itself has not expanded meaningfully. Mining output faces constraints. New discoveries require years to develop. Environmental regulations increase production costs. Existing mines often struggle to maintain output levels as ore grades decline. Recycling contributes supply, but not enough to offset structural deficits when demand expands. When demand drivers multiply while supply remains constrained, upward price pressure accumulates gradually. Now let's address the Jane Street litigation more directly. Large market makers operate with informational advantages. They see order flows before retail participants. They execute across asset classes simultaneously. Their algorithms respond in microseconds. Legal scrutiny revealing aspects of how these firms structure trades underscores the complexity of modern markets. Retail investors trading leveraged futures must recognize the asymmetry they face. That does not mean opportunity does not exist. It means understanding the difference between short-term trading and long-term accumulation becomes critical. If you trade paper contracts against institutions optimized for speed and liquidity extraction, you are operating inside their ecosystem. But if you accumulate physical metal over time, focusing on supply-demand fundamentals rather than short-term volatility, you shift the playing field. Physical ownership removes counterparty exposure. It bypasses leverage dynamics. It aligns directly with structural shifts in pricing power. Now let's revisit the divergence between East and West. For decades, Western exchanges set price because they controlled liquidity. But liquidity follows confidence. If physical buyers increasingly reference Shanghai benchmarks, if premiums persist, if delivery volumes increase relative to paper turnover, pricing influence gradually rebalances. This is not an overnight revolution, it is incremental erosion. Think of pricing power as gravitational pull. For years, New York and London exerted dominant gravitational force. Now, Eastern markets are gaining mass. As mass increases, gravitational influence shifts. The more physical metal flows eastward, the stronger Eastern pricing mechanisms become. That metal flow matters. When silver leaves Western inventories and moves to long-term holders in Asia, it does not easily return. Accumulation patterns differ. Cultural and strategic approaches to precious metals vary regionally. Once metal migrates into vaults aligned with long-term accumulation strategies, available float diminishes. Now consider the scenario unfolding if these trends persist. India expands collateral adoption nationally. Households embrace the program. Selling pressure decreases. Fund capital slowly allocates toward metals exposure. Gold maintains its breakout above 5,280. Silver continues outperforming with double-digit percentage moves. Open interest gradually rebuilds as new participants enter, but from a healthier base. Shanghai premiums remain elevated. Physical deliveries increase relative to paper settlements. In that environment, Croup's $150 projection begins to appear less aggressive and more plausible. Price targets that once seemed distant begin to align with structural drivers. Of course, markets never move without volatility. Silver recently surged to $121 before collapsing to $65 and then recovering into the 90s. That type of move shakes conviction. It eliminates weak positioning. It reinforces the importance of understanding structural forces rather than reacting emotionally to short-term fluctuations. Volatility does not invalidate structural shifts, it tests them. Long-term cycles unfold over months and years, not days. During transitions, noise intensifies. Headlines amplify fear. Corrections create doubt, but structural fundamentals persist beneath that turbulence. Now the key question becomes this: are we witnessing the beginning of a repricing cycle where physical demand reasserts dominance over synthetic supply, or will Western paper mechanisms reassert control and suppress divergence? The answer depends on sustained behavior in the metrics we are watching. Shanghai premiums, India collateral adoption rates, institutional allocation percentages from that $385 billion capital pool, ComX open interest trends, gold to silver ratio compression, physical delivery statistics, inventory drawdowns, lease rates. These indicators collectively reveal direction. When multiple independent metrics point toward tightening supply and expanding utility, probability shifts. No single data point guarantees outcome, but alignment across policy, pricing, positioning, and capital flow increases conviction. Today, alignment is forming. The structure of the silver market looks different than it did even a year ago. Institutional tone has shifted. Eastern pricing has accelerated. Futures participation has reset. Policy frameworks have evolved. These are not random occurrences. They reflect systemic adaptation. Markets evolve quietly before they move loudly. Structural transitions rarely receive unanimous acknowledgement at inception. Recognition often arrives after repricing has already occurred. The current environment demands awareness, not emotion. It demands attention to fundamentals rather than fixation on intraday charts. It demands understanding that when pricing power transitions, volatility precedes stability. If these converging forces continue building, silver's trajectory will not be defined solely by speculative enthusiasm. It will be defined by structural revaluation. And structural revaluations, once established, tend to persist longer than expected. That is why today matters, not because of a single headline, not because of one projection, but because of convergence. Convergence creates momentum. Momentum creates repricing. And repricing, when supported by policy, capital, and physical demand, reshapes markets. Now let's bring everything together and focus on what comes next, because understanding the current shift is only useful if you can think clearly about how it might unfold from here. What we are seeing today is not a guaranteed straight-line move higher. Markets never operate that way. What we are seeing is the setup for a potential structural repricing driven by multiple independent forces moving in the same direction at the same time. And when that kind of alignment develops, the next phase can accelerate faster than most people expect. First, keep your eyes on the Shanghai premium. If silver in Shanghai continues trading above the Western ComX benchmark, that is physical demand sending a clear message. Arbitrage traders will attempt to close that gap by sourcing metal in the West and delivering it into Eastern markets where prices are higher. But here is the key point. When metal moves east, it does not casually flow back west. Much of that silver ends up in long-term accumulation channels. It goes into vaults, industrial pipelines, or private holdings that are not easily liquidated. Each ounce that leaves Western inventory and settles into Eastern demand centers reduces the float available to cap future rallies. Second, monitor how India implements its collateral policy nationwide. Announcing a policy is one step. Execution is another. How quickly do banks integrate silver-backed loan products? How aggressively do households participate? If millions of families begin using their silver as productive collateral instead of selling during liquidity needs, supply dynamics change in a lasting way. Selling pressure diminishes. Collateral locks metal into the financial system without returning it to open circulation. That shift, if scaled, compounds over time. Third, watch institutional capital behavior closely. The potential $385 billion in stock fund capital, capable of rotating into gold and silver, does not deploy overnight. Institutional money moves gradually, often quietly at first. But even modest allocations in a relatively small market like silver can move prices disproportionately. 5% of that capital represents more than $19 billion. 10% approaches $39 billion. In a market already experiencing structural deficits, those flows would not be absorbed easily without significant price adjustments. Fourth, continue tracking ComX open interest. When open interest sits at a 13-year low, it tells you leverage has been flushed out. If open interest begins rising alongside price, that suggests new money entering with conviction rather than short covering. That combination is historically bullish. If open interest rises while price falls, that indicates new shorts building positions, which could temporarily suppress upside. The relationship between price and participation reveals who is driving the market. Fifth, observe the gold to silver ratio. Gold recently broke above $5,280 per ounce, gaining 3.5% over the last week, while silver advanced nearly 11%. That kind of silver outperformance compresses the ratio. Historically, when the ratio compresses meaningfully after extended elevation, silver enters its more explosive phase. Silver tends to lag early in precious metal cycles and then accelerate sharply later. If ratio compression continues, it would confirm the transition toward that aggressive stage. Sixth, pay attention to physical market indicators. Premiums, delivery volumes, inventory drawdowns, lease rates, and registered stocks matter. When premiums remain elevated and deliveries strain available inventory, paper pricing mechanisms face pressure. Persistent physical tightness is difficult to mask indefinitely. Eventually, physical demand asserts itself through repricing. Now let's address a question that inevitably surfaces. If all of these factors are bullish, why is silver not already at $150? The answer is straightforward. Markets adjust through stages. Structural shifts unfold gradually before accelerating. Along the way, volatility tests conviction. Silver recently surged to $121, then collapsed to $65 before recovering into the 90s. That type of move eliminates weak positioning. It discourages speculative excess. It forces participants to reevaluate risk tolerance. Volatility is not evidence that a thesis is wrong. It is evidence that markets are processing information. Structural forces like India's collateral integration, institutional allocation potential, Eastern premium persistence, and reduced speculative leverage operate over extended timeframes. They do not resolve within days or weeks. Now consider a forward-looking scenario. Imagine several months from now, India's collateral programs are fully integrated nationwide. Millions of households are borrowing against silver rather than selling it. At the same time, institutional funds have initiated modest but growing allocations into precious metals exposure. Shanghai continues trading above Western benchmarks, drawing metal east. ComX inventories trend lower as deliveries increase relative to paper settlements. Open interest rebuilds from healthier levels as new participants enter. Gold maintains its breakout above $5,280, reinforcing macro strength. Silver continues outperforming, compressing the ratio further. In that environment, Croup's $150 projection no longer feels distant. It feels achievable, not guaranteed but plausible. Plausibility is the foundation of repricing. When price targets move from improbable to conceivable, capital flows accelerate. However, intellectual honesty requires examining alternative outcomes. What could disrupt this thesis? A sharp global recession could weaken industrial demand. A dramatic easing of geopolitical tensions could reduce safe haven interest. Unexpected new silver supply discoveries could alleviate deficits. Regulatory frameworks enabling fund flows could stall or reverse. India's collateral rollout could face adoption challenges. Western institutions could temporarily suppress prices through coordinated leverage strategies. These are real risks. Markets are complex. Prudent investors define invalidation points. At what evidence would you reconsider your outlook? What price levels or structural changes would alter your thesis? Without predefined criteria, conviction turns into hope. Hope is not strategy. But risk awareness does not negate structural momentum. It refines positioning. The people who benefit most from paradigm shifts are not those who chase headlines after price has already doubled. They are those who recognize convergence early and position rationally. Right now, convergence is visible. Institutional projections have shifted upward. Eastern markets are trading at premiums above Western benchmarks. India has integrated silver deeper into its financial system. Potential capital flows measuring in the hundreds of billions are now possible. ComX open interest reflects a washed-out speculative base. Legal scrutiny has revealed structural asymmetries in market making. Gold is confirming macro strength and silver is outperforming. That is not coincidence, that is alignment. Alignment does not guarantee immediate acceleration. It signals potential energy building beneath the surface. Markets often move quietly during accumulation phases. Repricing frequently occurs when least expected. The central question becomes this: are we witnessing the beginning of a decoupling between Eastern physical pricing and Western paper dominance? If physical demand increasingly dictates valuation, synthetic supply constraints weaken. Paper pricing mechanisms rely on acceptance of cash settlement equivalents. If participants increasingly demand physical delivery, pricing power shifts toward those controlling real metal. For decades, Western exchanges maintained dominance because participants accepted paper contracts as substitutes for physical ownership. But when premiums widen and delivery interest increases, that substitution assumption faces stress. If that stress compounds, repricing becomes structural rather than speculative. Today, we are not observing a single bullish headline. We are observing multiple independent developments reinforcing one another. Institutional expectations, physical market divergence, policy transformation, leverage contraction, and capital flow potential are converging. The next phase depends on persistence. If Shanghai premiums remain elevated, if India's collateral adoption expands, if even a fraction of that $385 billion capital rotates into metals, if gold maintains strength above 5,280, if silver continues outperforming, and if open interest rebuilds constructively, then the structural case strengthens further. And when structural cases strengthen, markets eventually respond. So now the responsibility shifts to you. Are you merely observing these developments, or are you analyzing them? Are you positioned with awareness of both upside potential and downside risk? Are you reacting emotionally to short-term volatility, or are you evaluating structural forces? Paradigm shifts rarely announce themselves clearly at the beginning. They reveal themselves through convergence. Today, convergence is unfolding across continents and institutions. The silver market stands at an inflection point. Croup has projected $150. Shanghai has traded above $100. India has unlocked collateral utility. Potential fund flows measure $385 billion. ComX open interest has reached a 13-year low. Jane Street litigation has exposed structural dynamics. Gold has broken above $5,280, while silver outperforms. These facts are not speculation. They are present conditions. What happens next depends on whether these forces continue aligning. But one thing is clear: the structure of this market looks different than it did before. And when structure changes, price eventually follows. Stay rational, stay informed, stay prepared.